So hello and welcome back to our YouTube channel everyone, and today we are back with another educational video for all of you, and today we are going to continue our derivative series. So this is the session 4 of the derivative series. If any one of you is new on the channel and have not watched our previous 3 videos, please go and watch them, because all these videos are interlinked and they need to be watched in a manner that we have uploaded them. So please go to our channel and watch them and then come to this video, because all these videos are very knowledgeable. We have shared every inch of the derivatives to you. All things that you need to know about the derivatives have been communicated in these videos. So if you are a trader of derivatives, or if you want to become a trader of derivatives, then you should have your basics clear. So go and watch all the videos. So here on the session 4 we will be starting with the futures. In the session 3 we have concluded with the forwards. What are the forwards, what are the problems with the forwards, and how does trading takes place in the forwards. And today we are going to talk about the futures. So forwards and futures are almost same. The only difference between the forwards and future is that futures solves the problems those were associated with the forwards. So as we have talked in the last session, that there are two main problems associated with the forward contracts. Those problems named as lack of liquidity, and second is counterparty default risk. If anybody wants to square off his position before the date of the contract, before the end date of the contract, then you can't do that, because there is no liquidity available in the forward contracts. Second problem was the counterparty default risk. What happens if you and me came into a contract and I defaulted? Might not pay you anything and I'll run away. So what you can do, all you have to do is that you have to run behind me, you have to sue me, and you have to follow all the legal procedures. Those are in place. Too much of hectic and too much of time taking. So what we have done, or what the regulators of the market have done, they took the forward contracts from the OTC markets and they have put them into the exchange traded market, named them as futures contract. So what happens in a futures contract is that exchange becomes the intermediary for everyone. If I want to buy something, then exchange will be the seller, and if you want to sell something, then exchange will be the buyer. Okay, so like this, the liquidity problem is resolved. The liquidity that was the problem with the forwards has been resolved. And the second thing, the counterparty default risk problem has been resolved in this manner, that exchange takes a margin from you. So what kind of margin exchange take? If you know that whenever you come into an derivative contract, a futures on a forward or an option, you buy, you have to pay some money. In forward contract, you were not paying anything. Exchange were taking at the end of the contract, but here while entering the contract you have to pay a margin. So in this manner, exchange is taking a performance guarantee from you. In case you lose the money, then exchange don't need to ask for money from you. They already have it, so they will pay me. So this is how futures work. And how that margin is decided, how much margin exchange should take, is that they uses different formulas and algorithms to decide how much movement a share price can do in one day. A particular share price, say Reliance can move 500 rupees in one day. So if Reliance moves 500 rupees in one day, what will happen to the futures contract? How much movement will be there in the futures? So okay, there will be a movement of 300 points in the future. So let's take a margin of 300 points from anybody who is entering into the contract. So this is how they decide the margin, and that margin is a performance guarantee. And that's how, if the default risk has been killed completely. And second thing, they are standardized. For futures are standardized. You have to take a minimum lot, like there are lots available for different stocks and different indices. The lots have been decided, like Bank Nifty. If you heard about Bank Nifty, 25 is the lot size, and for the Nifty it's 75. For the Reliance stock is 505 or 550, something like that. So this is how they have standardized these things. And the margin keeps on changing mark to market on each and every day. Whatever the gain and loss that you has been occurred in your account will be credited or debited from your account. So this is how the trading takes place in the futures. and this is how futures are better than the forwards. But the problem with the futures is that forwards contract are something in which two people can do whatever they want. The forward contract are customized, they are over the counter, as we have discussed in the session 2 also, that the OTC derivatives are very customized. They are according to the need of the people, and here exchange traded are standardized. They are according to the rules created by the NSE or by the BSE. So this is the problem, they are standardized, and forwards are customized. That's why still forward contracts do take place, but they take place in the big players of the market. Suppose Reliance is taking futures of the Infosys, or might be some JP Morgan, or any big firm, analytical firm, or any big hedge fund, Goldman Sachs taking and a few forward contract with Reliance, or might be taking with Amazon. So that kind of forward contract still do take place in the market, but those are for the big players. If you and I will go to any bank or to any dealer who provides the OTC market, we will not get any kind of forward contract with them. They need the big players. So if the person with whom they are coming to the forward contract is big, then the problem of default has gone, and the liquidity problem is not there, because these players come into the contract with a future perspective only. So liquidity is not a problem for them, definitely, but it was a problem for us. That's why the forwards contract has been put it on the exchange, so that we can also come into forward contract, and they are named as the futures, and all the aspects of the forwards and futures have been communicated to you. You can see the forwards and futures on the any trading platform or on your Demat account, and you can simply take entry into them. So this is the logic behind it. So I hope all of you have now got the futures, what are the futures and what are the forwards, and I hope this video was educational for you. You have learned something new. Now we will be moving to the next sessions, to options and financial swap, the remaining kind of derivatives that we have not covered till now. So thank you so much for watching this video, everyone. Please do like this video. Don't forget to share this video with your friends and family, and do subscribe the channel and press the bell icon to get the notification of every new video that we upload. So thank you so much, everyone.